Welcome to Season 1 of Common Sense, where we aim to educate and empower Black entrepreneurs who are dedicated to the growth of their businesses and their personal finances. I'm your host, Ayo Idowu, and I'm here today to talk about the vitality of life insurance with our guest, Tre Carruthers. Tre is a financial advisor who's the owner of a large wealth management practice in Dallas, active member in his community, and sits on boards of many nonprofits, a public speaker on many topics, mostly financial literacy, and a husband and a father of two, and just all around a great guy. So Tre, I'm super happy to have you here today, man.
Thank you for having me.
So before we kind of get into it, I did a short bio, but I'd like to learn more about you, man, from your perspective. Tell us about your story. Yeah. Tell us about what you do, day in the life. What is it like to be Tre Carruthers?
Tre Carruthers. So I've been in the business 20 years. You mentioned my family, been married 23 years. I've built a practice with integrity over that time period. I've had a focus on empowering people that look like me, even employing people that look like me. And so as I've transitioned, as the practice has grown over that time period, I've gotten to the point now where I can really make an impact and give people an opportunity that I didn't have. And so when you look at the wealth management industry, you rarely see practices that are led by people that may look like us, or even that are staffed by multiple people that work like us. So that has been my goal. That has been my focus. When I go out and speak in the community, it's all about education, financial literacy, giving people the knowledge, and then hopefully providing them the opportunity to take steps to be better stewards of their finances.
So you employ Blacks, African Americans in your practice, and you're obviously proud of that. So let me ask you a question. Obviously, that wasn't the case for you coming up. So what was it like for you, and what kind of what was the catalyst of you saying, "No, I don't want nobody else to go through what I went through"?
Yeah. So as I was coming through 20 years ago, it's amazing to say that, but I was in an office with about 50 plus professionals trying to build their practice. And I think there was two of us. All right. And so just from a percentage standpoint, what's that, 4 or 5%? When you look at the overall industry, but that's also most industries. It's just not financial services. If you look at most professional industries, we make up 5% or less. And so to be in a position, and some of the reason that is because when we get to, or when we grow practices, we like to keep things to ourselves. And as an entrepreneur, with integrity, you also have to understand that the opportunity won't come from other people, because people hire who they like or who they're more comfortable with. So I'm comfortable with myself, with my people. And so if I can employ my people, then I'm giving someone else an opportunity, and hopefully we can just grow it from there.
So do you feel like it was kind of your duty to not be selfish and just kind of keep everything to yourself and keep growing as a big solo advisor? Is that what pushed you to it? Because obviously there's not a lot of us in this business. Yeah. And like you said, there's not a lot of us kind of, running conglomerates such as you are.
Yeah. I've evolved into that. So over the past 5 to 6 years, of course, with everything that's been going on culturally, I've just noticed or picked up that if I didn't do it, not sure other practices or people that didn't look like me would do it as well. So DEI is a big word, right? However, it's one thing to be in a position where you hire people and give them an opportunity, but it's another thing to put them in a position where they can be successful. So the right person in the wrong situation will lead to a wrong result. All right, the right person in the right situation will lead to a right result. And so what I try to do, just through my experience of building a business as a black professional, is putting people that look like me in the right position to get the right result. And we're not. I'd probably say more minority. So our advisors are Black, our support staff, Mexican, Hispanic descent. And so just trying to build an inclusive business.
How about your clientele? Well, what kind of people do you work with? What type of folks do you service?
Same thing. So try to be as inclusive as possible. And building the practice, of course, I can't work with everyone. You understand,
right?
As the practice grows, you can only
wish we could, right?
But, I know you can't be connected to every client, all right? And you can't provide ideal service. And so we have a service model that I like for our clients to receive. And because of that, I know that I can't provide that model to everyone. All right. And so to grow, I wanted to bring on more people that we can just enact that service model with more clients. And so that's what we're doing. So we're just trying to work with as many people. We've been fortunate enough to surpass $100 million in assets.
Wow.
And surpass it pretty comfortably. And then from there, we just want to make sure that we put people in positions with comprehensive planning, right? And so it's one thing to have a bunch of money, but if you don't have the right protection around it, right? You could build a castle, but if you don't have a moat around it, you can't protect the castle, right? And so that's where things like life insurance come in place, disability insurance, just protecting everything that a person may build over time.
So you say you had $100 million. That was one thing that caught my eyes, right? Your practice just surpassed $100 million, which congratulations.
Thank you.
That's a huge milestone in a lot of advisors' careers. When you first started, right? Well, let's just talk a couple years in. Did you see this coming? Did you see $100 million coming? Multiple employees, or was this not quite part of the goal?
That's a great question. It wasn't part of the goal. So in candor, I grew up an only child. So as I was building the practice, I just envisioned building this business and keeping all this money and
keeping it moving.
Yeah. And maybe hiring a staff or two and playing a lot of golf and doing different things. But like I said, I've evolved. Some of my leadership experience and positions that I had with an organization put me in a unique position to gain perspective on how important it was for people like me to employ people like me.
Right. And are a lot of your clients kind of like that too, where they are minorities who own businesses, where they're also trying to employ people?
We do have a good amount of entrepreneurs, self-contractors that are working to employ, put people on, basically what it is. And so, yes, when we look at our higher net worth clients, I'd probably say 65 to 70% of our higher net worth clients are Black clients, are minorities. And so building a business that looks like that is, definitely something we could be proud of.
So you work with a lot of entrepreneurs. You're an entrepreneur yourself. I think this is great because we're obviously on a podcast with Common Sense where we're aiming towards working with entrepreneurs that, entrepreneurs are very good at what they do. And there's so many things when it comes to the house of how you need to keep it clean and in order to be able to remain successful. Getting successful is tough already, but remaining successful is one of those even harder parts.
Yeah.
Let's switch gears. Let's talk about life insurance. We feel like life insurance, the vitality of life insurance is one of those things in order to keep a strong foundation of a financial house is very important. So I'm going to ask you a few questions, and I would just like you to go ahead, spit fire, answer them the way you want to. I think the first question when it comes to life insurance is, what the heck is it, right? Like I feel like life insurance is one of those things. It's been a hot topic, whether it's social media, whether it's blogs, smartasset.com, whatever it is, but you can't go anywhere without hearing about it.
Yeah.
So just tell me the basics of life insurance, and we'll build off it from there.
Yeah. So first, to piggyback on your question, the fact that it's talked about more is a good thing. So I'll say that. Life insurance, in essence, provides a lump sum amount of money to a beneficiary or to whomever you choose for the coverage of a death, right? And so I have life insurance on myself. I die, my beneficiaries, my family will receive a lump sum of money, all right? And that's what life insurance is. A lump sum of money to cover the passing away of an individual. And so the one thing about life insurance is it puts those that receive it in a better position to make decisions, have flexibility, maybe not have to go back to work, not have to sell off your home, just different things that the benefit of life insurance provides. And like I talk in my house, I just ask, just give me 30 days for my spirit to pass before you throw some type of party or have, some new guest in my house. So that's all I ask.
So don't replace me too quick.
Just
Come
30
on,
days. Give me 30 days.
Got the interim head coach just knocking on the door already.
I've been waiting. You get that life insurance policy yet?
Thank you for explaining that because I feel like that's important.
Yeah.
There's so many, and we'll get to it later. There's so many aspects of life insurance. I feel like people forget what the basics is, right? It's literally the point of it is to replace either income that would have been made or to just to receive a death benefit, cash tax free to some heirs. So let's talk about the different types of life insurance. Can you give us a quick synopsis on the different types, or maybe just go broad and we'll kind of go down the ladder?
Yeah. So at its foundation, there's two types. Term insurance for periods of time are permanent. Permanent meaning as long as you pay a premium or the policy has cash value, you will have that policy for the remainder of your life. And so when I first started off, one of our leaders used the term, used the concept for permanent as, do you want to have insurance when you die? All right? Because the stats say, and proven, unproven, that term insurance pays 3% of the time. Most people outlive the term. All right. And so I'll talk more about term. So term is for 5, 10, 15, 20, 25 years, whatever the time period is, you have this death benefit.
Okay.
All right. And if you get it at 25, you get a 20-year policy. You get to 45, the policy becomes really too expensive for you to keep.
Right.
And then you have to go back through the process again. That's term insurance. In essence, term insurance covers you for a period of time at a manageable cost. All right, the cost of insurance for a term is a little bit lower.
So if I get a 30-year term policy, right, let's say it's $1 million. If I die between now and 30 years.
30 years, yes.
My family gets $1 million. Or whoever I elect as my beneficiary.
Whoever you choose as beneficiary will get $1 million. They won't pay tax on that. So
now,
you alluded to earlier, the death benefits on life insurance policies are tax-free.
Tax-free. So Uncle Sam doesn't touch it. Whatever the death benefit is, they all getting $1 million, correct?
That is correct.
So what if if I were to die 30 years in one day outside of that policy and I did not create another policy?
Yes.
Do I get something? Do I get a little bit?
No.
You don't get Nathan?
Won't get a dime.
Okay.
Yeah, they'd be setting up a GoFundMe and selling plates somewhere, trying to get money for a service.
That party won't be as big.
No,
probably.
It won't be. It won't be. And then so that's
the repast food gonna be trash.
Oh,
too.
it's not gonna be good.
Horrible.
That's not gonna be good. It's gonna be definitely baked chicken. But so that's term. Permanent insurance is, like I said, where as long as you pay a premium, it will be there.
Okay.
So another concept for it is cash value.
Okay.
So cash value life insurance. Permanent or cash value life insurance. Same thing. There are different types of permanent or cash value life insurance. We don't have to get into the weeds on that today.
Right.
But just understand that it will be there as long as it has cash value or the premium is covered by the cash that's within it.
How does one create cash value?
Great question. So one creates cash value by paying the premium over time. So with term insurance, the premium is set. So what you pay is a set number for whatever that term is. For permanent, the premium is a set number for the cost, but then there is a maximum that you can put into a permanent policy.
So you can choose how much you want to put in within a range, right? So I could pay more or less per month?
You can. Okay. I wouldn't advise it.
Okay.
Right? You want to run what's called a healthy policy.
Right.
And so you want to pay whatever the projections are for that permanent policy to work for the remainder of your life.
Okay.
And so most of them will give you a number and say, hey, what do I need to put into this policy so that it does not lapse at least by the time I turn 75?
Okay.
Whenever we run policies, we like to run policies that show clients living to 120. Now, we know that's not going to happen,
right,
but we want to make sure that clients are putting enough cash in those policies to where they can be rested assured that there will be life insurance when they die.
Because the death benefit is the most important part.
Death benefit is the most important
part.
So
even if there could be a lot of cash, it could be a little cash, but at the end of the day, that cash is probably going to be minuscule compared to the death benefit, correct?
Yes. Yeah.
Okay.
The death benefit will always exceed the cash value.
So it
has to by IRS rules.
Yeah. Okay. Yeah. Good to know.
Yeah.
So here's my question to you. I've never heard about life insurance before.
Okay.
The way you've explained those two, I feel like I want to go with the cash value. Why would somebody ever go with term? Why would somebody ever go with cash value life insurance?
That's a great question. So term is about affordability, right? So term insurance, because it's it's a risk reward, right? It doesn't cost as much. Whereas permanent, it's going to be there.
Okay.
So as long as you pay that premium, so because the insurance company knows as long as there's cash value in there to cover that policy, we're going to have to pay out a death benefit. It's going to cost a little bit more.
Okay.
Right. And so term is a little bit cheaper. Or like for myself, I have both. And so what I encourage clients to do or people to do is you may get a term policy to cover, let's say you just had a baby. You may get a 20-year term policy to cover the expense of that baby going to college, right? And so by the time that baby gets to 20, just in case, by the time that baby gets to 20, if you hadn't passed and hopefully you've built up enough money, you can still pay for college. If you did pass during that time period, that money is set aside to send that child to college.
Okay.
All right, the permanent policy is in place because I want to have something when I die, and then I'm also building cash value that grows without taxes. I can take money out of it without taxes. I can either loan money to myself or I can do a surrender. And so because of that feature, all right, especially as you earn more income over time, cash value life insurance does make more sense. So if you were to say which policy is I don't know if better is the term, but cash value life insurance or permanent insurance is definitely a better option for the investment because you want to make sure that somebody gets something. You're putting money into it.
Yeah.
You want to make sure somebody gets something.
So that second time around, you started using grow and investment. So cash value. When I think cash, I think the money's just sitting there. But you said that money's growing as well. So not only in a permanent policy am I putting in a premium, which is probably more than the term, but the money that I'm putting in or that's in the cash value is not stagnant. It's growing?
Yes.
Okay.
Yeah. In most cases, it's growing. So whole life is growing at a fixed rate of return. Universal life, a little bit better fixed rate of return. And then you could either have index or variable. Okay. Where if it's in an index, it's based on, say, the S&P 500 index. It will grow at that pace.
So it's like putting money in the stock market, but getting life insurance as well, too.
It can be. Okay. Yeah, it can be. Yeah, because that cash, like you said, the cash value can grow.
Okay.
It's growing and you're not paying taxes as it's growing.
So while we stay on the topic of term and permanent insurance, obviously you talked about one being more expensive, the other one being more affordable, but one only covering a certain period of your life. Now, what if I'm at a point in my life where I can afford just one of those policies, and then I happen to come into more funds, let's say that.
Yeah.
Is there a way I could jump from one policy to another, or do I have to go back into underwriting?
Yeah, good question. So once you have a permanent policy, you have it. Right? You don't need another permanent policy, or you don't have to go back through underwriting. One of the features of term insurance is that they have a conversion period. And so usually for most companies, it's half of whatever that term is. So if it's a 20-year policy, it may be 10-year conversion period. If it's a 30-year policy, it may be 15, or it may be the entire time. Some policies allow you to convert at any time during the process, during that term period. And so you can convert it from a term policy to a permanent policy. It could be a whole life. It could be a universal life. It could be a variable universal life. It doesn't matter what type of permanent policy. The great thing is you don't have to go back through underwriting. And so as part of that conversion, whatever underwriting rating you got, at whatever age you got your term policy is what you'll get as part of the conversion. So that's the great thing about converting from term to permanent is you don't have to go back through blood and urine samples. They're not checking your weight. They're not checking your cholesterol.
Thank God about that weight.
Yeah. So you get to go through that process without having to do underwriting.
Okay. So it's okay for me to essentially buy a term policy now with the hopes to buy a permanent policy down the road?
Oh, yeah, definitely. Okay. To convert down the road?
Yeah.
Yes. From an affordability standpoint, it makes sense.
Do you practice that a lot with your clients?
We have, yes. We have had clients have term policies while they're building their wealth and at a point in time convert to a cash value life policy.
Is this every term policy, or are these like certain riders that you have to pay more or less for?
That's a great question. That depends on the company, right? That depends on the company and if the term conversion option is provided. So I can't answer because that is company specific. But it is something to review. So you had asked a question earlier, what should I be looking out for before I sign the contract? And so that would be one of the questions I would ask. Can I convert this term insurance policy to a permanent insurance policy in the future without having to go through underwriting?
Okay. And if that's important to me, obviously ask that question before you even start the process, correct?
100%.
Okay.
Yes. Yeah, you want to do it before you even sign the initial illustration, right? Because that could impact the underwriting. We just never know.
Well, it sounds like, I mean, is it that much more expensive? Because it sounds like this is something that I probably would, even if I didn't think I was going to get permanent insurance, I'm like, why the heck not?
Well, it depends on when you convert it.
Yeah.
Right. And so if you buy a policy at 25 and you don't convert it until 40, yes, it's going to be a significantly higher premium than what it would have been.
Okay, so here's another question for you.
Mm-hmm.
Besides the tax-free death benefit, right? Because you've named a few things there, but what are some perks? Because I feel like people always get blindsided by the perks of life insurance sometimes rather than the point, and we talked about that. What are some of the perks of life insurance altogether, right?
Well, perks meaning for the death benefit or just the cash value?
Well, we know life insurance is about the death benefit. So what are some other cool things that life insurance enables people to do to their financial situation besides just pay off their family if they were to pass early or during the contract?
Yeah, so at its foundation, I think life insurance provides the flexibility for you to be able to do other things with your money. So if you know if I know I have life insurance in place, I can go off and invest and do other things, knowing that if something happens to me, my family's okay. So at its foundation, I think ample life insurance provides flexibility. So I run into situations with clients all the time where they're trying to either keep the family home or keep a certain amount of money because I want to leave it for my children and grandchildren. And so what I try to instill in them is, let's get a life insurance policy that will give them, your beneficiaries, what you want to give them, and you spend your money. Like, you go live life because as soon as you pass away, they're going to get that life insurance benefit. So at its foundation, that's one of the benefits. I already talked about term and that it's lower cost. So really, cash value life insurance, a lot of the benefits are, like I said, the tax deferred growth, being able to loan money to yourself, right?
Can we pause real quick?
Yes.
Tax deferred growth, what does that mean?
Great question. So tax deferred growth means an asset or a value of money that grows over time and you're not paying tax on it on an annual basis.
Because generally in the market, you would be paying taxes as money's growing?
Depending on the account, right? And so unless it's what's called a qualified account, a 401k, an IRA, something 403b, those grow tax deferred as well. But any account that is outside of a retirement plan or life insurance or I guess a 529 plan, since we're being technical, would be taxed, right? Home equity up to a certain amount is not taxed. But if you have rental property, savings accounts, everything else is taxed.
So here's where the financial advisor in me comes out. Obviously, you can put up to 22, next year is going to be even more, but 22,000 into a 401k plan. And that is tax deferred. But let's say you're making an ample amount of money that you like to put away. You're saying you use life insurance kind of to create a tax deferred vehicle beyond the 401k for higher earning clients?
Yes, definitely. Yeah, for those clients that you run out of options. So I can't do a Roth IRA. I make too much money. I'm maxing out my 401k. Then definitely cash value life insurance is a next progression from a savings standpoint. I even prefer to look at it before a 529 plan simply because of the flexibility. 529 plans have to be used for college. They did make a change in the latest Secure Act where it could be transitioned to the kid as a Roth IRA. Right. But it's still the kid's money, right? Whereas with the cash value life insurance, it allows you to save, grow tax deferred. You can use it to pay for college. You can use it to buy cars. I've had clients invest in businesses with their cash value life insurance. I had clients pay off their mortgage and just pay themselves back with their cash value life insurance. It just gives you so much flexibility.
So not every entrepreneur is kind of at the pinnacle of their career yet where they're generating a lot of income. Not every W-2 employee of a large company is there either. Let's say you're just getting started out, or let's say things are rocky. Maybe we can't afford the Cadillac of life insurance policies. What's kind of like a minimum you want to make sure people have at all times?
Yeah. From a death benefit standpoint, meaning the amount that you would leave to your beneficiaries.
Yeah.
So the minimum that you want to look at is at least enough to cover your debts. right? And so if you have a mortgage, if you have student loans, if you have car loan, if you have credit card debt, whatever your debts are, you want to have that covered with your life insurance, death benefit, particularly a mortgage, right? Because a mortgage doesn't go away.
Right.
Credit card debt, they can come try to knock on the door, but unless it's a joint card, they probably not gonna get that money, right? So, but even with student loans too,
they can have a plate at the repast. But
they can try. Even with student loans too, right? Because there's some grace with student loans upon the passing of the owner of the student loan. But you want to at least have enough to cover the debts.
Okay.
Right. Whether it be medical bills or whatever the debts are, you want to be able to cover those.
So at
a minimum.
So in your calculation, it is, it's not the student loans, it's not the credit card debt, but it's the mortgage, maybe the cost of raising a child for the next 18 years.
Yeah. So I don't know if you get that as a minimum though, right? Because the cost of raising a child or even replacing someone's income. Right. So like if let's say a person makes $50,000 a year, right? And you're trying to replace that income over the next 20 years, that's $1 million in life insurance.
Right.
If they make $100,000 a year, that's $2 million. So if you're replacing income or trying to look at raising a child, then the number goes a little bit higher.
Okay. Now,
don't get me wrong. I've never been in a situation where there was too much life insurance. And that's actually a question I get. Is there such thing as is too much?
Well, I'm going to ask that question right now. Is there such thing as too much life insurance?
To me, no. Yeah, to me, no. It comes down to affordability. So if you can afford it and you're not compromising your lifestyle, your retirement goals, things of that nature, there's no such thing because you're leaving money to the next generation. Generational wealth is a huge term in our community right now, right? And so there's no better way than through a life insurance policy because of what you invest over time. As long as we can be unselfish, right? What I invest in my life insurance policies over time, I couldn't save up or grow fast enough to leave a benefit to my beneficiaries tax-free. It's difficult, right? And so they get it, and it's guaranteed no matter. So I might live another day, I might live another 30 years, but I don't know that.
Right.
And because I don't know that, I know that my family would be taken care of.
So you talked about some things, and I appreciate that, by the way, because I feel like that was a very good kind of deep dive into the why and the how. Again, if you're reading anything financially, if you follow Wall Street Journal, CNBC, any talking heads when it comes to finance, and you talk about it too with generational wealth and funding items once you put money into a life insurance product. So can you explain the whole insurance as a bank concept? Because I see it everywhere. I read it all the time. Yeah. I mean, I don't have TikTok, but I feel like if you scroll 5, it's going to be something like, man, stop getting out a loan from a bank. What you should do is boom, 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 right? So can you explain the concept first? And then I definitely going to have some follow-up questions.
Excuse me. So the bank concept has become very popular through social media. And first, let me say, I'm not against it, right? I think if you understand it, it is a sound philosophy, right? Building that bank is where I think people miss the opportunity, miss the boat. And so it takes time to build cash value in a life insurance policy. First and foremost, it's a life insurance policy.
Right.
So you're paying a premium for the life insurance policy. The only thing that builds cash value or your bank is any extra that you're paying more than the premium. So if your premium is $100 per month and you're putting in $100 per month, you're not building a bank.
Ain't no cash value.
There's no cash value.
So it's basically a term policy at that point, as long as you keep paying those.
As long as you're paying that monthly premium. If you're putting in $1,000 per month and your premium's $100, then you're building bank.
Okay.
But still, at that rate, that's what, $900 a month, and then over so long, that's what, $10,800 in a year. And so it takes a while to build that money. All right.
And I can't buy a house with $5,000.
No, but over time, yes, you can. Yes, you can build cash value and use it as a bank. It's just the popular thing right now makes it seem like it's immediate. And of course, and nothing in this space life insurance or entrepreneur is about immediate gratification.
Okay.
It's just social media makes it feel like immediate gratification is a real thing. It's not. And so building the bank component of a permanent or cash value life insurance policy just takes time.
So probably early on for most people, you'll probably still need to utilize a bank, but the goal is maybe towards the end of life when we have hundreds of thousands of dollars in these policies, or maybe by the time a child's 20, right, going off to school and has 50, 60, 80,000, that's when you talk about your clients buying cars and paying for college, and you're loaning against the value of the cash. So you're not actually taking the cash out.
No.
You're loaning against it.
You can take the cash out, but it really doesn't make sense because most cash value life policies, after either 10 or 15 years, allows you to withdraw money, loan money to yourself with no interest.
Right.
All right. And so like I said, we've had clients and to add to the point.
It's free to draw to loan money against yourself versus surrendering the policy.
Yes, it's what's called a net zero loan.
Okay.
Right. And so the insurance company will charge you 2%. Then they'll give you a 2% credit. Okay. Right. And so it ends up being a net zero. It's not quite free technically, but
it sounds like it's cheaper than a bank.
It's cheaper than anywhere.
I'm looking at houses right now and they're talking 7-8%.
Yeah, it's cheaper than anywhere.
Okay.
Yeah. So if you can build the cash value and loan that money to yourself, it's definitely a great way to go. It just takes time. That bank concept, like I said, it just seems so immediate. It just takes time to build it. And depending on when you start. So if you have high income in your 20s and you start in your 20s, then by mid 30s, you got money that you can access and do a lot of things with.
So let's say I have some sort of windfall come my way and I have a lot of money at one time. What if I don't want to wait and pay every single month? Is there another option for me? I just came up on $500,000. Can I just put $500,000 into a policy right now?
Yeah. Traditionally, you can't, right? Because the IRS has rules around cash value life insurance and how much you can put into a policy in 1 year. All right. And so it usually has a cap on it. The higher the death benefit, the more money you can put into it in 1 year. Okay. But you can rarely take a lump sum and just dump it into a policy and still keep all of the benefits around tax deferred growth and be able to take the money out. So if you put it all in at one time, it turns it more into an endowment policy and it has certain rules around it.
Okay, so it's kind of a give or take. It's because again, I'm over here thinking, I'm like, well, why wouldn't I just take all the money I got put in here and just keep borrowing against myself?
Keep loaning to yourself. Yeah.
Okay.
Yeah. It's so. I don't know if it's as we'll call it folklore. The way we learned it was the IRS had to put caps on it because there were certain entities on the East Coast that would try to use life insurance policies to move money around.
Go ahead, call them out, man.
Who did it? No, we're not calling anybody out.
Sound like you know something.
Yeah, but yes, there were entities, organizations, organized.
Never mind.
Entities.
We don't want to call these people
exactly.
out. Sound good. Yeah.
All right. So that's and so the IRS stepped in and said, "Hey, we gotta put some limits on how much you can put into a policy at one time."
I think that's a great segue. Obviously, that strategy was illegal, but can you talk about some strategies you use with your clients, especially with the entrepreneurs? Money's coming in different ways. I feel like I can only imagine the different situations you've been able to not only use the definition of life insurance, but the perks, right? Do you have any other strategies you've seen that are completely legal? Obviously, we have the entities on the East Coast, but some strategies you've used with some high income earning entrepreneurs, or even some modest income earning entrepreneurs.
Yeah. So depending on the goal or when they may need the money, I mentioned college earlier. Definitely, my clients that espouse to do real estate down the road, create passive income streams. We'll start the cash value policies early, start to build up that cash. That way they can loan money to themselves in the future. That's definitely a strategy. For the entrepreneurs, if you don't want to start a retirement plan, because most retirement plans, if you have employees, you have to match it, or you have to, whatever you contribute to yourself, you have to contribute to your employees. If you want to put money away, have it grow without taxes, that you don't have to contribute to employees, maybe you get a policy in that space.
So you're saving money on essentially saving for retirement without having to save. Obviously, we want to give our employees retirement options, but if that's not the case yet, or maybe we're at a point where we
it depends on the business too, though, right?
We can contribute as much as we want without technically having to increase what everybody else is getting?
Up to the IRS limit,
Okay.
right? And of course, it depends on the business.
Okay.
All right, and so if I have a bunch of contract workers, or if I'm in the fast food industry, or I may not want to start a retirement plan for these people, right? I may just want to be able to save my money and not have to match or do different things. So, or I may just be a solo entrepreneur and looking for ways to save money outside, in addition to a retirement plan. I may be maxing out my retirement plan. And so therefore, where else can I put money and grow it without it, grow it tax deferred?
So here's a question. Talking about social media earlier and a lot of just common misconceptions out there. I'm sure people come to the office with, I don't want to call them cockamamie ideas, but stuff you ain't never heard of. And you're like, well, I heard I could do this, right? Let's play a little myth busting game, right? Can you name some myths to life insurance that you feel like a lot of people think are there, but actually it's not the case at all?
Pause. What's cockamamie? All right. That's okay.
I saw, what was it, Back to the Future? He was like a cockamamie idea having,
I didn't know.
Inventor, right?
Yeah, I didn't
That's
know
a word. I have never read it.
Okay.
But I'm sure it's out there. Somebody said it.
Touche.
Yeah. Somebody smart too.
Okay.
Yeah.
I just wanted to know so I can answer the question right. So a lot. Of course, there are myths around life insurance. All right, and so.
By the way, we just confirmed that is a word. So,
it is. Yeah. Oh, somebody actually.
Continue.
I love it.
I want to know how it's spelled later, but we'll talk about that.
I love it. So, I don't know. Let me go with some of the. I don't know if I'll go myths, more negative connotations.
Okay.
Especially in our community. So I'm gonna speak directly to our people.
Okay.
We are underinsured. Period. We don't have nearly enough life insurance.
We got all the GoFundMes in the world.
Yeah, we don't have nearly enough life insurance. We have a misconception that, and yes, insurance companies are in the business to make money.
Period.
All businesses are in business to make money. However, if I'm going to invest in something, if I'm not being selfish, that's going to ensure that the next generation will be in a better position than I was when I started, why wouldn't I invest in that? And so at its core, life insurance puts the next generation or your family, your spouses, whomever it may be, in a better position than what they were before you passed away, or even maybe before they met you. So why not do that? It's really befuddling. We don't buy term and invest the rest. All right. I'm going to buy term insurance and invest the rest of my money. No, you're not. You're going to spend that money. You're going to spend that money. So you're not saving by buying term and quote unquote investing the rest.
So in theory, that's a good idea, but most folks in your experience
just
never do it.
It's a great idea for a shorter period of time, but less than 10% probably do it.
It's just the actual execution is what people lack. Okay.
Yeah, and then
so
also,
you feel like buying life insurance is a good way to kind of force saving.
It can be.
Okay.
Yeah, it can be if it's affordable.
Yeah.
Yeah, it still has to be affordable. Which the buy term invest the rest leads me to the next thought of you will outlive your term insurance more than likely. And so one of the pitfalls of term insurance is that if you buy it at 25, if you buy it at 35, if you buy a 20-year policy, especially for us, once we get to 45, 50, can we even be insured again?
We're not insurable at that point.
It gets tough.
Because you have to go through testing before, or what do they call it?
Underwriting.
You have to go through underwriting before. So they don't just hand out insurance. You have to essentially be, okay.
No, whenever you sign up for a life insurance policy, other than something you see through Gerber,
okay,
you are going to have to go through underwriting. Underwriting meaning they're going to take blood samples, urine samples. They're going to request your doctor's records. They're going to see everything. And once we hit 45, 50, we run into diabetes, hypertension, weight issues, whether it be alcoholism, smoking, whatever it may be. We run into things that prohibit us from being insurable.
So you're saying it's best to buy insurance when you're younger, healthier, leaner, what have you, right?
If you can afford it permanent.
Yeah.
Right? And so if you can get a permanent insurance policy at a younger age, you will always have something in place.
Okay.
Because, like I said, the likelihood of outliving your term insurance is high. It's just, it is what it is. So another misconception myth, group life insurance isn't enough.
Like
right? Through your employer.
Define group life insurance real quick.
So most employers provide a form of life insurance coverage for their employees. It's usually a multiple of your salary. So it's either 1 times, 2 times, 3 times your salary. All right. Maybe 4 times if you're an executive.
So even at your salary, that's not enough, you saying?
No, no, it won't be enough. But for 2 reasons. It's not that the number's not enough.
Mm-hmm.
If you have insurance tied to your employer, what happens when you're not with that employer anymore? You don't have the insurance.
So it's there as long as you're working.
As long as you're employed, you got insurance.
Okay.
You ever get laid off or you just have a bad day and you saying, I'm leaving, right? I'm out. Then you don't have life insurance anymore. And so I've encountered people, I have life insurance through my job. No, that's not enough. You need to have an independent policy that has nothing to do with your work environment.
Because just like term is for a certain period, group policies are for a certain period. And that's as long as you work there.
As long as you
now,
work there.
what if the argument is, well, I work for Chevron now, but I'm about to get a job with Pepsi. I'm gonna hop on their insurance.
You could,
yeah,
right? We just don't know what happens in the transition. I mean, life is short.
Yeah,
we just don't know.
And at some point, you're gonna retire too, right?
Yes.
So it's like you're not gonna have group insurance.
No, you won't have insurance when you retire. And more times you won't have health insurance either, but that's another topic.
But do you think people should still attack the group life insurance? Because
you want to get it. Yes. So group life insurance is a great thing to have because it provides a significant death benefit for a low number. All right. Your cost of insurance is very low because they're grouping you with all of the other employees of that company. So you're paying a rate based on being in a group of people. It's a group discount, basically.
So so it's like buying insurance in bulk then at that point. So whatever you get at work, you're getting that cheaper than you are for
as an individual.
As in the private policy, let's call it that. Okay. So group life insurance is great, but you feel like that's the first step. That's not the pinnacle. That's just like get group life insurance, but we're gonna do this too to make sure that you financially fit.
Yes, you want to have layers to your insurance life, your insurance policy. Yes.
Why do you feel, especially people of color, but I'm gonna talk about Black folks. Why do you feel Black folks feel so negatively about insurance at times? Especially, I don't know, I made a joke earlier, but we see a lot of GoFundMes when people pass. We see how the breadwinner dying can not only ruin a family for that generation, but for generations to come. We see how the fighting over the cost of a funeral happen and people start to lose their ties with other family members. Why? Like, what is it about insurance, or maybe it's the people selling it? I don't know, but what is it about it that you feel makes us kind of step away from it and take a step back?
You want the truth?
I mean, yeah. As long as these microphones are hot, I want to hear it.
Okay. We don't think we're gonna die. Straight up. We as a people, we don't like to talk about death. The only thing in our profession that is guaranteed, I can't guarantee returns on investments. I can't guarantee how much you're gonna make on cash, but I can guarantee every client I sit across from is going, myself included, we gonna die. But for whatever reason, we don't like investing in a guarantee. We'll go play the lottery.
Sure will.
We'll go to the casino.
Come on.
We'll buy squares for the football game.
We'll bet on the Cowboys.
It's better than betting on the Vikings.
I was just seeing which one's more likely, right? The lottery or the Cowboys getting out the first round. My bad. Let's lock in.
Yeah, good gracious. But we'll do a lot of things, but we won't get coverage for the one thing that's guaranteed. So the foundation for why we don't like life insurance is because we don't like to talk about the fact we gonna die. That's the foundation. Second, it could be affordability. It could be underwriting. And then you also deal with some of our older parents, grandparents may have had policies that lapsed over time.
And they have a negative connotation.
Have a negative thought around it because they didn't know that as you get older, you may have to put more money into it.
Right.
They may have some old whole life policies that
or premiums are increasing. They get mad because they feel like they're getting had.
Yeah, they getting over on me. Why I got to put more money into this and don't see it as an investment in the next generation. And so, but it's still all rooted in the fact we don't think we're gonna pass away at a point in time. So that's some of it too. And then, like I said, if we can be unselfish, selfishly, and I hear it, I don't want to leave too much to the next generation. I don't want to leave them too much.
Because I had to work.
Yeah, because all they're gonna do is blow through it. Well, let them figure it out. Don't put them in a position where they're gonna have to figure out how we're gonna pay for your funeral, how we gonna pay the taxes on this property. There's just so many things that are provided from a life insurance benefit. It's my clients that don't have enough, or the clients that I've had pass away that didn't have life insurance versus the one I have a client that husband died of cancer 10 years ago. This client probably received over $1 million, right? The client paid for 2 colleges. The client has literally gone through $1 million+ over the past 10 years and still has money because of that life insurance policy. And so that's why when we talked about earlier, there's no such thing as too much. Right. But it's still rooted in, we don't like to talk about life and death. We could talk about life insurance. We could talk about estate planning. Number one reason we don't get wills. Oh, what you betting on me dying? I mean, it's
yes.
It's going to happen. It's going to happen. So that's,
You mentioned something. I thought this was real good. I'm gonna circle back on it.
Okay.
Talking about especially elders or people in the family member that have had bad experience with the life insurance. Mm-hmm. Now your title is financial advisor, and you talked about kind of what you do with your clients and your service model. You're a holistic advisor that not only talks about insurance. Today we are, but you do a lot of other things for your clients, mainly financial planning, and then from there draw out what will be the next thing or topic we talk about. Now, there are folks that don't do what you do selling life insurance, correct? And now life insurance is known as a commission game.
Yes.
Do you feel like, let me start here. Do you feel like that's kind of why people don't learn all about their policy and can be surprised later in life and have a bad taste in their mouth because they purchased it from someone who took the commission and basically didn't follow up on the policy over time?
100%. Yeah, definitely. That is a factor.
Yeah.
Especially if it is a non-planning financial advisor. Most insurance companies that sell life insurance are doing it for the reason to sell a policy.
Right.
There's no service behind it. And so that's one thing, right? And then second, I started in the business when I was 26, 27.
So you've been working a couple of years, is what you're saying?
And so a couple of years. And so the policies that I sold to my clients when I was 27, 28, if I retired 60, 65, I'm no longer around. So who are they going to go to? Now, hopefully, I'm building a business that there will hopefully always be someone in position.
Yeah.
But they lose connection with whomever sold them the policy.
Yeah.
And so that can also lead to them having policies that disappear, or where they just it essentially ends up being a vacuum for your money.
So what do good financial advisors, what does Tre Carruthers and his associates do to make sure that doesn't happen, right? Because a policy could look one way day one, especially cash value policy.
Yeah.
It sounds like that's going up and down based off the market. If the market goes real bad, my policy could be in hot water. And if it goes great, we may never have to talk again. Who knows, right?
Yeah, good point.
But what does Tre Carruthers and other top line financial advisors do to avoid that?
Yeah. So we annually review our policies with our clients. But one thing that I do as well, that we do as well, is for our older clients that may have policies outside of our company, I'll have them bring those in and review them. Just because those are the ones that are in danger of lapsing.
Right. The ones that aren't under your care.
Yeah, clients that bought, like a lot of people probably don't even know, General Electric used to sell insurance like in the 50s and 60s. And so I have some clients, I had a client that had an old GE life insurance policy. And so we had to look at it and say, okay, what can
OG life insurance, huh?
Yeah. What can we do to keep this? And so we had to put more money into it for a season for him to keep it. And he eventually passed away and his family got the money. But we'll review, especially for my older clients, we'll review old policies to make sure that they're that they remain solvent.
And has that helped out with people, having the misconception, especially folks like us, having the misconception of what the policy is? Are you letting them know, like, hey, this is great for this term, but just know after 20 years, your premium might increase.
Mm-hmm.
Or I've had clients that get surprised, like, I just got this letter saying I got to pay no more. What? I didn't know that was going to happen. Like, that's a good surprise. But again, you're letting people know about these ahead of time. And
from an education standpoint.
Not just selling the policy and kind of running away. You're selling the policy and kind of standing by the policy for the life of yourself or the policy, whichever one, kind of is done first, right?
Definitely. From an education standpoint, we like to review any products that clients have. We like to review them on an annual basis.
Okay.
Or as part of our meeting structure. So this is what you have. This is an annuity. This is how it works. This is cash value life insurance. This is how it works. This is cash. This is how it works.
Yeah.
And so just walking through the products on at least an annual basis.
So make sure if I get a life insurance policy, I'm getting it reviewed by somebody. If not, I call Tre and his people.
Annually. Yes. Annually.
Okay.
Yes.
Okay. So here's a question I got for you, man. And it's probably the last question of the day, but I feel like a lot of questions will kind of pop up from it.
Okay.
I step into somebody's office.
Mm-hmm.
They put a policy in front of me. It's a lot of money, but we just listened to this podcast, so we're super excited about getting life insurance and stepping forward.
Mm-hmm.
But I'm a little bit nervous because policies look like phone books, right? I'm obviously not going to read it page to page, and I obviously don't have a law degree or a JD to be able to decipher everything.
Yeah.
What advice would you give to me before I go ahead and sign that? Is there any due diligence you feel like I should do? Any questions I should ask before I just go ahead and kind of sign a big life insurance policy?
Yeah.
Well, or even a small one, really.
Yeah, unless you're going to a company that is not reputable, I think you're okay.
So what's a reputable company?
A company that you were probably referred to or that you're familiar with, right?
So a big name?
Yeah, you could always go through the Better Business Bureau and make sure that they have accreditations. Most insurance companies have to go through an annual rating system that you can look up as well, and to make sure that they have the cash to back the policies that they have in place. But I'd say as long as you refer to them.
Okay.
Of course, I don't want to name any companies in this space.
So like if a company has, they had the Cotton Bowl and they signed behind the field goal post, probably has enough money to pay out your policies, is what you're saying.
More than likely, yes. If they're
But if it's one of them back rooms and, the chair's squeaky and, this drip asbestos in the ceiling, probably.
Yeah. Just check it. Now, there are insurance brokers that have access to different companies that may be able to get you an affordable policy. And so it may still be a reputable company. Just understand what you're investing in.
So broker as opposed to an agent?
Yes.
So what are the differences between the two?
Well, an agent more times than not works for one particular company.
Okay.
Right. And they're providing life insurance from that one company.
Okay.
A broker is independent and will provide life insurance from multiples of companies and just looking for the best deal. They're compensated by all those different companies.
So do you feel like one is better than the other?
Not per se, no.
Just whatever your preference is, right?
Wherever you have the relationship.
So if I'm looking for the best deal, I'll probably go to a broker. But if I'm looking for my relationship and I just want to make sure, hey, he gonna make sure I have the best products, or he gonna make sure I have every product for myself, I'm good. I don't need to see all the other companies. I like this company. I want to stick with this company.
Potentially.
Okay.
Potentially. To assume that brokers are giving you the best deal, I think would be erroneous too.
Okay.
So you just never know. Yeah, business, more times than not, good business is about good relationships.
Okay.
Yeah. So
that's another thing. If I don't have a good relationship, I probably shouldn't sign.
I wouldn't buy life insurance for somebody I don't know. But going into it, so I would start even before you sign the policy, right? And so the underwriting process is the most important thing if they're going to nullify your policy. So you want to be as transparent as possible in the underwriting. So answering your questions, they're going to ask medical history, they're going to ask nicotine usage, alcohol. They're going to ask all those things, right? And so you just want to be as transparent as possible in that process, because the only thing that could be disputed in the payout of a life insurance policy is if there was something that wasn't disclosed during the underwriting process. So that's,
and they ain't gonna tell you until it's time to claim.
Till it's time to claim.
Interesting.
Yeah. Like if you somehow you had a battle with cancer 8 or 9 years ago that you didn't disclose, that comes out during the settlement process.
Right.
That could be a problem.
Okay.
So
but if the cancer happened after you got life insurance, you're okay.
Yeah. Oh, yeah. After you get it. Yeah. After you get it. Or even you can disclose it. I've had clients that had cancer 10 years ago and still get underwritten because it passed a certain period of time without that they were cancer free.
Right. Okay.
So you can have diabetes, you can have cancer at an important time and still be underwritten. So going back to one of the myths earlier, a lot of times people won't sign up for life insurance or even try because of their previous health situations. And so, I mean, all they're gonna do is tell you no. But don't tell yourself no, thinking, oh, I can't get life insurance.
I mean, that's what they told me in middle school, but it'd be worse than that sometimes. I'm just telling you no.
Yeah, okay. I mean, all they're gonna say is you can't get underwritten.
Okay.
But at least give it a try, especially if you have previous health issues.
Okay.
Like your likelihood of death earlier is higher, right?
So different carriers maybe?
Yeah, maybe go to a different company.
Okay.
I mean, you could try it.
Yeah.
They'll still ask, have you been denied by another company? And so you'll have to answer that question.
Okay.
So that's prior to.
Okay.
Once you're in the position where you're signing the life insurance, if it's term, you just want to review, okay, this is the amount of years that I'm going to get it for, 20, 25, 30 years, and the premium. That's not going to change, right? As long as you know the years and the premium, that's set.
Okay.
Check your beneficiaries, right? Make sure your beneficiaries are correct on the policy that you chose. If you're not married, then if it's your niece, nephew, if it's your parents, just make sure that's right. On a cash value policy, you'll want to review the death benefit. You'll likely want to review, okay, what's the most I can put in? What's the minimum I can put in? You still want to check the beneficiaries, of course, but the cash value policies, there's a little bit more to learn about it as you sign up or as you sign the contract to have that policy. But just know that the policy is not enforced until you sign it. Right. And so you can dispute it all you want to. But, as soon as you sign that policy, pay the first month's premium, you are fully insured.
Okay.
More advanced because some of us or some of our parents may be second generation wealth or have more to lead to the next generation is how do I transfer this wealth properly? Right. And so one of I believe the Secure Act of 2019 put in a very subtle rule that IRA money, 401k money, transferred to non-spouse beneficiaries has to be withdrawn over a 10-year time period. So just imagine if you're not married, but you have a child, right, that is 19, and you pass away with $500,000 in your 401k or let's say $100,000 in your 401k or your IRA. That 19-year-old is going to have to take that money out over the course of the next 10 years.
And something tells me when he takes it out, it's not going back in nowhere.
It's not going back nowhere, right? The likelihood of it is low, all right? And so one of the things that we like to approach or at least discuss with our clients is, hey, can we get a life insurance policy that you can set aside and put your child as a beneficiary or whomever, spouse, because they're going to get that money tax-free, right? And then the second thing is a life insurance policy you can put in a trust. So the life insurance policy, the beneficiary may not be an individual. It could be a trust that you have set up, which sets the rules for how they can withdraw that money. So trust, and those are sold a lot now too. So that's becoming more and more popular.
Yeah.
Should I get a trust? Should I get a trust?
So what is a trust?
Ooh, now you're trying to get me in trouble. Trust is a legal document. All right. Well, I'll leave it at that. I'm not an attorney. Right. A trust is a legal document that allows the person that's setting up the trust to set the parameters for how their assets are transferred. Best way I can put it.
So it's kind of like a purgatory between, let's say, you would have passed, God forbid, but you would have passed and you would have passed money to me. It's kind of like a purgatory where those assets sit before it goes to me. And in that purgatory, you're saying that you get to write the instructions for how I receive them.
Yes, there are rules. There are rules for you to get this money, right? With IRA 401k money, you really can't do that, all right, because of the Secure Act rules and changes. So what you can do from an advanced strategy is you can have the life insurance benefit go into a trust, all right, or to the beneficiaries is tax-free. 401k IRA money you can send to a qualified charity. Any IRA money or 401k money that goes to a qualified charity, 501c3, it could be a church, it could be anybody, it is not taxed. So you can send all of your IRA 401k money to a qualified charity. It's not taxed. Your life insurance money can go to your beneficiaries. It's not taxed. So you essentially dying tax-free. Or you can split it. You can change it up how you want to do it. But there is a way to transfer your wealth and minimize the tax hit. As part of the internet era, right? And we talked about banking or the term bank being used for life insurance.
Right.
There are also opportunities to transfer life insurance or death benefits to companies that'll buy out the life insurance policy from you or on you even. I've heard of people selling their own life insurance policies. The difficulty with that is you're selling it at a discount, right? So you're not getting the full benefit.
Right.
They're not. So if the death benefit is $500,000, they're not going to give you $500,000 for a $500,000 policy.
Right.
They're going to give you a discounted number and keep the policy. And just think about the return on that. So if I give you $100,000 for a policy on someone else's $500,000, as soon as that person dies, I just made $400,000.
Right.
Yeah. And the reason
but it's more money you would have seen.
Oh, you would have, yeah, if you'd have just been patient or waited it out.
Well, I mean, you was going to die.
You're going to die.
So
anyway,
that money wasn't your money.
That's a good point.
It's a living benefit.
So that's why people would do it.
Okay.
It's because, hey, I need this money. I might need this money to live right now. And I have this life insurance policy that, I can sell and get something for it. So, I mean, I could see in that sense it would make some sense, but
is there a big market for that?
I'd be leery of it. I don't know if it's a big market. I can't answer that question. But it's a real thing.
Man, we got a side hustle coming up. Start buying these policies.
It is a real thing, though. Yep.
So Tre, man, thank you so much for coming today. I thought this was phenomenal. I think everybody at home learned a lot. I think a lot of people in this room learned a lot as well. I mean, you talked about what life insurance is. You talked about term versus permanent, which I feel like a lot of people get confused on, which they shouldn't after this session. The different aspects of policies and kind of how they work. Becoming your own bank, which is a big topic out there, especially for people under the age of 50 trying to navigate life. And then you also busted some myths that we can finally go ahead and say are either true or real, and some misconceptions in the Black community about it. So thank you so much, man. Before we head out, is there any other advice you'd like to give to entrepreneurs, whether it is within life insurance or outside life insurance or just business in general?
Yeah, so earlier we talked about why entrepreneurs may grow or may hire, may not hire. And so one of the things that when I talk to entrepreneurs, and one of the things I had to learn was the concept of infrastructure. Right? And so one of the most difficult things that an entrepreneur can work through as part of a growth initiative is having the proper professionals around them, what I call infrastructure. So whether it be a CPA, a bookkeeper, someone that does your health insurance benefits, the professionals in place that allow you to grow, right? Because you get to a point where you can't reconcile your books every month. You can't do all of the hiring and benefit packages. You may have to outsource an HR professional or virtual. I mean, everything is virtual. You can't always answer the phone, right? You may have to have a virtual assistant. So building infrastructure and investing in that infrastructure. So you have to invest in your growth. Right. And so you can't put all the money in your pocket, and you can't just save it all in the bank. You can't grow without putting more money in. So that as revenue increases, if you want to grow exponentially or grow over time, you have to be able to outsource. You have to be able to build your infrastructure. You have to be able to hire, and that requires us to be unselfish and be systematic with how we do it.
Tre, where can we find you and your team, or if we want to learn more about it, or just follow you on social media and whatnot?
Yeah, so on Instagram, LinkedIn, just my name, Tre Carruthers. Last name Carruthers, TRE, no Y, but just put it together and you'll find me.
You ain't got no TikTok, nothing like that?
No,
not yet?
I'm past the TikTok generation. I look young, but I'm older than what I look.
Thank you guys for watching this episode of Common Sense. Again, I'm your host, Ayo Idowu. If you'd like to get more content from us, please like, subscribe, and follow our page.